Hi, it's Nash from Alpha Phi, and today I'm going to continue talking about the options if a client has the question of if you cannot or do not want to pay any more into the policy, what are those options? So we talked about the premium offset. Today we're going to dive into the reduced paid up, and then that third option is the automatic premium loan. So premium offset, just going over them briefly real quick again, uses the annual dividend to pay the annual policy premiums, but it keeps that premium due so that the policy continues and those premiums are still buying whole life insurance. The reduced paid up option, the premium is reduced to zero and the policy is paid up. The dividends will grow, and as long as it's the PUA option for the dividend, which all these policies that we design are selected and designed that way, then the death benefit and cash value will continue to grow year over year as those dividends are credited, but no more contributions can be made to the policy, both to base premium but also to PUAs. Then the third option, just for review, is the automatic premium loan. This uses existing cash value to pay the premium, increasing the loan balance and collateralizing the death benefit. So this is really a safety net in case your premium comes due. There's normally a grace period or window that you have to pay the premium, let's say plus or minus 15 days of your policy anniversary date. If the automatic premium loan is structured to your policy and issued that way, then if you go past your grace period, it would automatically take a loan to fund the premium for you. And the premium offset and reduced paid up are the two options that are in force, meaning that you have to actually get your policy, and then at the time that you want to enact these, you have to actually submit some paperwork to the company and activate the premium offset or the reduced paid up or the automatic premium loan, as long as it's attached to the policy is automatic and would just be your safety net for you, always ready and waiting. Okay, so the reduced paid up, and taking a deeper dive into that. So the premium, the base premium, is reduced to $0 from whatever it is. And the policy is paid up for as much as the cash surrender value will purchase as a single net premium. So it takes that cash, a single net premium is paid, and you basically have a life insurance contract where you don't have to contribute any more money. The RPU option also allows the policy owner to retain their permanent coverage under the same conditions as if the policy had not been reduced. So all the other options and things like that are still in place for you. The only exception is that you can't contribute more to the policy. So nothing else is impacted essentially. The policy continues to earn dividends, and with the PUA option selected, the death benefit and cash value continue to grow as the dividends are credited year over year. So that compounding will continue and is not interrupted. And in fact, it's enhanced because a lot of that insurance expenses and all of that are cut off the policy, and then it's just true pure growth. And so the IRR, if you look at it from that standpoint, really takes a step up and takes off. And then any PUA rider previously in force will become paid up, and the client cannot contribute to that rider anymore either. So you can't contribute to base premium. You also can't contribute to the PUA rider. All right, let's look at an example in a policy and how this exactly works. So what we've got here, if you watch the premium offset video, this is the same $250,000 target max policy funding for 5 years. This is a 50-year-old client, preferred plus non-tobacco, so good health rating. And we've got our annual base premium here, buying whole life insurance. So Guardian has a company limit of basically 11 times the base premium is the total contribution limit. So that's why this is a weird number. But if you take 250 divided by 11, you'll get this number. So that's the minimum that you can do going into base premium in this design. And then the rest is going into paid up additional whole life insurance. So about less than 10% going to base premium, more than 90% going to PUAs to generate very high early cash value. Okay, I've got a little snapshot here of that policy so we can mark it up. And this is illustrated with those base premiums being paid here for 1, 2, 3, 4, 5, 6, 7 years here. That's that base policy premium. And then you'll notice that it's zero thereafter. This is because this is illustrating us performing a reduced paid up in the future in year 8. Again, it has to be enacted at that time. It can't automatically be set up that way. So in year 8, that takes place. So what's going on here is that is cut off the net cash value, or the net cash surrender value. So at this time, that would be right at the end of year 7 is when we would probably enact that. That's 1.371402 million. And then you'll see the death benefit here actually takes a drop. And the reason it drops from 3.9 to 2.8 is that we took that and we bought that single net premium policy. So the death benefit resets because we're done paying it. It's paid up. We're not paying any more base premium, which this policy and this product is an L95. It means that it's assuming you're going to pay from age 50 until age 95, that $22,727. When we do this, we're saying we're not paying anymore, we can't pay anymore, so it's buying that single net premium. So that death benefit is dropping because we're not paying until we're age 95 anymore. And then your cash value and your death benefit continue to grow, and actually at a more substantial pace, because we've cut that expensive life insurance costs and fees and that sort of thing. So that's the good side. The downside is that you cannot contribute anymore. So say you're still making a lot of money and you want somewhere to store your liquidity that's safe, liquid, tax-free. You can't, after you perform a reduced paid up, you cannot put any more money into the policy. So that would be the downside. All right, that is the reduced paid up, the deep dive version. Let me know if you have any questions. Please like and subscribe, and I will be talking to you soon. Thanks. If you enjoyed this video, please like and subscribe. Also, you can learn more at alphacrusaders.com at the link at the end of this video.